Welcome to The Explainer. Today, we're going to crack open a document that's over 50 years old, but I promise you, the investment wisdom inside is absolutely timeless. We're diving into Warren Buffett's 1972 shareholder letter, and you'll see how it laid out a blueprint that's just as powerful for investors today.
So it all kicks off with this number, 19.8%. Now what is that? Well, that was Berkshire Hathaway's return on shareholders' equity in 1972. I mean, that's a stunning number for any company. But for a business that started as a dying textile mill, it's almost unbelievable.
And that's the big question, right? How on earth did a dying textile mill pull this off? How did Buffett wring out these kinds of returns? Well, the answer is in this playbook he was already perfecting. It's a masterclass in capital allocation, in long-term thinking, and we're going to decode it today straight from the source, his 1972 letter. Okay, so here's how we're going to break this down. First, we'll look at the scorecard for 72. Then we'll get into Buffett's true north metric, the one that really matters. We'll tackle this wild idea, a profitability paradox. Then we'll cover managers, money, and moats. And finally, we'll piece together the enduring Berkshire blueprint.
All right, let's jump right in. First up, the 1972 scorecard. Let's look beyond that headline number and see where that incredible 19.8% return really came from.
And the letter makes this crystal clear. Yeah, sure, all the businesses did better, textiles, banking, insurance, but the real story, the big driver, it was, and I'm quoting here, the dramatic gains in insurance underwriting. This wasn't just a small part of the story. It was the engine, the powerhouse that drove the whole company that year.
Okay, so this incredible performance brings up a really important question. How did Buffett himself measure success? Because if you want to understand his strategy, you've got to know how he keeps score. And let me tell you, it's not about the daily stock price or what the operating earnings were for the quarter. Nope. He has a totally different true north.
And that true north, it's all about growing the intrinsic value of the business, what it's really worth. His best and most conservative way to track that is by looking at the growth in book value per share. That's the yardstick. That's the one that matters more than anything else, because it tells you if the actual owner's stake in the company is getting bigger.
And wow, does this show you the power of that focus. Look at this. When his team took control, book value was under $20 a share. Just 8 years later, by 72, it had more than tripled. And, this is so important, he did it all without selling any new stock. No dilution for the existing shareholders. That's pure value creation.
And here it is, right from the man himself. The key takeaway is that he wasn't just growing the business. He was compounding shareholder wealth and doing it at a really fast, tax-efficient pace. This relentless, almost obsessive focus on compounding book value, that became the unstoppable engine that built Berkshire Hathaway.
But this is where things get really interesting. This is where you see the Buffett genius in full effect. He looked at the source of his biggest profits in 1972, and instead of popping champagne, he was incredibly cautious. This is a total masterclass in what we call second-level thinking.
He saw this paradox playing out. See, the whole insurance industry was raking in record profits. But it was mostly due to temporary factors, just good luck, really. But that good news, it had a really dangerous side effect. It was like blood in the water. It attracted a flood of new competitors, guys who were undisciplined, who started slashing prices just to grab market share. And in doing so, they were absolutely destroying the long-term profitability of the entire industry.
I mean, think about that. This is just a profound, almost unbelievable thing for a CEO to say. He's basically saying, you know what, I kind of wish we hadn't made so much money this year. It just shows this laser focus on the next 5 years, not the next 5 weeks. He knew deep down that easy money today often means really hard times are just around the corner.
So what did he do about it? His response was just a masterclass in discipline. He said flat out that Berkshire was willing to lose market share. They would write less business if that's what it took to maintain profitable pricing. Let the other guys chase growth that doesn't make any money. Berkshire would just sit back and wait for sanity to return to the market. Incredible.
Now, to pull off that kind of discipline, to be able to just sit and wait, well, you need two things. And these are two things Buffett was already a master at assembling. You need the right people running the show, and you need a rock-solid financial foundation.
And if you read the letter, it's amazing how much he gives the credit away. He says over and over again that Berkshire's success is all thanks to the incredible managers running the individual businesses. People like Jack Ringwald, Gene Abegg, Vic Robb. These were often the guys who founded the companies in the first place, and they ran them with that same passion, like they were owners, because they were.
So you've got these great managers, and then he pairs them with just immense financial strength. He points out in the letter that in both banking and insurance, Berkshire's companies hold capital strength far above industry norms. And this wasn't some happy accident, right? This was a deliberate core part of the strategy.
This table really lays out his capital strategy perfectly. You can see it's both super conservative and incredibly opportunistic at the same time. On one hand, he's got this fortress of extra cash, just for safety. But then, look at this. He also proactively borrowed $20 million in long-term debt. Not because he needed it right then, but so he would have the dry powder ready to go, ready to seize opportunities when everyone else was scared or forced to sell.
So when we put it all together, after digging through this letter from 50-plus years ago, what's the big takeaway for us as investors today? Well, it's that this is a remarkably clear and totally enduring blueprint for how to create real long-term value.
Let's just run through them. Measure your success by the long-term growth in book value. Understand that huge industry profits can be a warning sign of irrational competition. Prioritize profit over market share, always. Empower amazing managers and then get out of their way. Maintain a fortress balance sheet so you can survive anything and pounce on opportunities. And finally, be great at allocating capital away from dying businesses and into great ones. These principles, all laid out back in 1972, are the absolute core of the Berkshire philosophy. It's all about rationality, discipline, and a relentless long-term focus.
And that really brings us to the final question, one I want to leave with you. In today's world, right, with markets moving at the speed of light, with everyone focused on the next quarter, with just constant noise everywhere, which one of these principles from 1972 do you think is the most vital? Which one is the most critical for an investor's success right now? Definitely something to think about. Thanks for tuning in.